Good morning and welcome to T-Hub Capital, the Investors Lounge, the podcast where we explore financial market dynamics, emerging trends, and the insights that shape successful investments. Each week, we'll delve into the strategies and analyses that drive our investment decisions. You'll get an insider's perspective on the factors influencing markets and the potential winners and losers of tomorrow. Subscribe to the podcast to stay ahead of the curve and make informed investment choices. Enjoy listening.
Welcome to T-Hub Capital's The Investors Lounge weekly newsletter. Today's date is the 21st of July. Let's dive into the week's top market news. European markets hold steady amidst trade talks. European equity markets largely held their ground as investors closely monitored ongoing trade discussions between the United States and Europe. The Pan-European Stocks Europe 600 Index concluded the weekly period roughly flat in local currency terms. Among the major stock indexes, Italy's FTSE MIB showed a gain of 0.58%, while Germany's DAX and France's CAC 40 Index experienced minimal changes. The UK's FTSE 100 Index, however, saw a 0.57% increase, partly bolstered by the weakening of the UK pound against the US dollar, a factor that typically supports the index given the significant overseas revenue generated by its multinational constituents. In the United Kingdom, consumer price inflation unexpectedly climbed to 3.6% annually in June, up from 3.4% in May, marking the fastest pace since January 2024. This acceleration was primarily driven by higher transport costs, particularly for motor fuels. Services inflation, a critical indicator for the Bank of England, remained stubbornly high at 4.7%, suggesting persistent underlying cost pressures, contrary to analyst expectations for an easing. The UK labour market also showed signs of cooling, with the unemployment rate rising to 4.7% in the 3 months leading to May, up from 4.6% in the preceding period and reaching its highest level in 4 years. The number of employees on payroll further decreased by an estimated 41,000 in June, following a decline of 25,000 in May. Annual pay growth, excluding bonuses, slowed to 5.0%. A slight dip from the upwardly revised 5.3% reported in the previous month, though it was still marginally higher than analysts' forecasts. Conversely, industrial production in the euro area demonstrated a robust expansion of 1.7% sequentially in May, a notable rebound from the 2.2% contraction in April and surpassing market expectations for a 0.9% increase. This growth was fueled by increased output in energy, capital goods, and non-durable consumer goods. On an annual basis, output accelerated significantly to 3.7%, compared to just 0.2% in the prior month. Furthermore, the Eurozone's trade surplus expanded more than anticipated, reaching EUR 16.2 billion in May, up from EUR 12.7 billion a year earlier, as exports grew by 0.9% while imports decreased by 0.6%. German investor sentiment surged in July, with the ZEW index of economic sentiment rising for the third consecutive month to 52.7, its highest point since February 2022. This figure exceeded the 50.2 forecast by analysts in a FactSet survey. The Economic Research Institute attributed this optimism to expectations of potential economic stimulus and the anticipated swift resolution of the European Union's trade dispute with the US, with nearly 2/3 of polled experts predicting an economic improvement. Now our insight into alternative markets. Streamlined private company valuation. Techniques for an opaque market. Valuing private companies is inherently complex, a stark contrast to public companies whose transparent stock prices and financial reports offer immediate insights. This podcast explores the common methodologies professionals use, highlighting both the techniques and the challenges in assessing a private business's worth. Understanding these limitations is crucial, as private company valuations can vary significantly, as seen in Elon Musk's acquisition of Twitter, now X Holdings Inc. Unlike public firms that sell ownership through IPOs and adhere to stringent SEC reporting standards, private companies keep their financials confidential, maintaining ownership among a select few. While public companies readily access capital markets, private firms rely on private equity and venture capital, necessitating a firm valuation before investment. Private companies fall into three main types, each with unique valuation challenges. Small and medium-sized enterprises (SMEs) often have limited financials, requiring adjustments for commingled personal/business expenses. Middle market firms have more structured, often audited financials, but still lack public reporting standards, typically using EBITDA multiples for valuation. Large private companies resemble public firms with robust reporting, but illiquidity and lack of market visibility still lead to valuation adjustments like liquidity discounts. The primary valuation method is comparable company analysis (CCA), identifying public companies similar in industry, size, age, and growth. Analysts use peer groups to calculate average valuations, often applying an illiquidity discount to private firms due to harder-to-sell shares and limited capital access. The EBITDA multiple is a common metric to determine enterprise value. Discounted cash flow (DCF) analysis is another key technique, forecasting future cash flows and calculating their present value by projecting revenue, costs, and free cash flow. Due to assumptions and limited data, private valuations are less precise than public ones. Key factors influencing private company valuation multiples include business size, revenue stability, diversification, capital expenditures (CapEx), intellectual property, growth potential, synergies, debt capacity, and deal terms. These factors are interdependent, impacting risk, return, and attractiveness. Financial ratios like working capital, profitability margins, and return on invested capital are also crucial. Assessing market risk for private firms involves analyzing similar public companies' beta market volatility, unlevering and relevering it to reflect specific financial risk, and then applying it to the weighted average cost of capital (WACC). Premiums for lack of marketability, size, and company-specific factors are then added. The case of X, formerly Twitter, demonstrates valuation fluctuations due to operational choices and market response. Its value significantly dropped post-acquisition, influenced by advertising revenue instability, uncertain growth potential, strategic changes, peer underperformance, and substantial debt. Private company valuations vary widely due to limited information, diverse methodologies, and fluctuating market conditions.
Thank you for listening to this episode of Hub Capital, the Investors Lounge podcast. I hope you found this content interesting and inspiring. If you enjoyed this episode, don't forget to subscribe to the podcast so you don't miss a single episode, and share it with your friends and colleagues who might be interested. To learn more about T-Hub Capital and our activities, visit our website, hubcapital.com. You can also follow us on our LinkedIn page. See you soon. All the best from the T-Hub Capital team.